Quent Beal here with comments on our session about inventories. We learned in our prior chapter on merchandising accounting that retailers have only one inventory classification, which are goods purchased for resale. We will stay focused on this subject, but we'll explore how retailers account for individual unit costs of inventory when they buy from different suppliers at different costs. We'll also assume an inflationary economy, that is, one in which purchase costs rise over time, so at any one time we have inventory values with different unit costs. Most retailers do not individually track the cost of each item and do not associate specific costs of individual purchased items when sold. This would be a costly practice and simply not feasible for anything other than high-priced items sold infrequently. So if retailers do not know the individual cost of an item when sold, how do they determine their cost of goods sold when a sale occurs? They make an assumption and will examine their choices. This will be the primary focus of this session, but we'll also explore some additional topics about inventory accounting. As mentioned, retailers carry only one classification of inventory, which are finished goods, ready for sale. This is what they buy and what they sell. A retailer may be purchasing direct from the manufacturer of the goods, and the manufacturer will have several classifications of inventory on their books. Raw materials bought by a manufacturer are a separate inventory classification. As materials become assembled or converted into finished goods, the inventory is called work in process. When completed but prior to sale, the manufacturer classifies the asset as finished goods, meaning no more processing required. So, inventory can take on different meanings based upon degree of completion. This is for manufacturers only, which are not the focus of this chapter. We'll also briefly revisit the question of when purchased items need to be included in the books of the buyer. That is, what purchase items controls the title transfer of title and therefore ownership. The inventory costing methods we will look at will require that we make an assumption before calculating the cost of goods sold when a sale occurs by a retailer. This is what is meant about the cost flow assumptions used when the specific identification method is not used. We will see logic that once cost of goods sold is determining using different assumptions, that this affects the remaining value left behind on the books for the ending inventory. That is, the inventory purchased for resale, but still on hand. We'll see that any given assumption, there are three we'll look at, for the cost of items sold will affect the financial statement's value of the remaining inventory not yet sold. This makes sense because the value of items sold and the value of items still on hand are cut from the same pool of available dollars. That is, any period beginning inventory plus the value of current purchases or additions forms a total universe of inventory costs that at period end are either sold or still on hand. We'll see this relationship by looking back at the flow of costs through an inventory T-account diagram. Because there is a direct relationship between the cost of ending inventory on the balance sheet, it's an asset, and the cost of sales on the income statement, any error in valuing ending inventory affects current values and calculations in the next period, which has a dual effect. One period's ending inventory is the next period's beginning inventory. Lastly, we'll look at some items of analysis for inventory, that is, putting the level of inventory into a perspective in terms of cost of goods sold, etc. As mentioned, our emphasis in this session will be on a merchandising company and not a manufacturing company. This slide just shows us a comparison side by side that the merchandiser retailer only has one inventory classification on their books. The inventory is finished goods, as purchased from perhaps a manufacturer directly. The manufacturing company on the right shows that they have three separate classifications of inventory. Raw materials coming in as purchased. As they begin to convert into finished goods, it's a work in process inventory. And finally, when it's completed or finished, it's classified as finished goods inventory. As noted, regardless of classification, companies report all inventories and their current assets on the balance sheet. This is because they expect to turn these inventories through sales and turn them into cash within the operating cycle of the business or within 12 months, whichever is sooner. In a prior chapter, we talked about two different systems of inventory control, perpetual system versus periodic. Perpetual means that the ending inventory is kept track of after every purchase and after every sale. So as you recall in a previous chapter, we made dual entries when it came to selling goods. We made a sale entry at retail and a cost entry which reduced the inventory value and pushed that cost into cost of goods sold. The periodic system, on the other hand, only determines the inventory on hand at the end of a period, and therefore determines the cost of goods sold at the end of the period, not after each sale. We will stay with emphasis on the perpetual inventory system in this chapter. It should be noted, however, that even companies that use a perpetual inventory system, that is, knowing what inventory levels are at every point in time, after every purchase, after every sale, that the taking of physical inventory is still necessary periodically to confirm that book balance of inventory on hand. So a perpetual system still relies upon a physical inventory periodically to assure that that which is believed to be on the books is indeed in existence for the company. The actual taking of a physical inventory confirms the existence of the amount of inventory that's expected to be on hand. This is not a small task. Many companies will outsource this rather than devoting employee time to take an inventory. It can be very time-consuming and can take as much as several days in a large store to determine what's on hand at a point in time. So as indicated, these inventories are generally taken when the business is closed or the business is slow, so that inventory can be counted accurately. Now, determining the amount of inventory that should be on the books of a company is not only a matter of confirming this by physical count periodically, but also which goods should be counted. When ownership changes is when inventory should occur on the books of the buyer. So for instance, there could be goods in transit bought in a certain term that delivers ownership when shipped from the seller's dock that should be included in the inventory, ending inventory of the buyer even before they arrive. Again, these are called goods in transit. They are purchased goods not yet received. So the goods are sold by the seller but not yet arrived at the buyer's point of delivery. These goods in transit, when ownership has occurred at the initial shipment of the goods, should be included in the books of the buyer when they're shipped. That is, when ownership title transfer changes hands. Legal title is determined by the terms of sale and not necessarily the physical possession of the goods. Here's two terms of sale terms that we've looked at in a previous chapter: FOB shipping point versus FOB destination. As we learned, the FOB shipping point means free on board at the shipping point of the seller. So at that point, the buyer takes title and should include those goods, any goods in transit, in their ending inventory if it occurs at month end. So ownership is being passed to the buyer when the transportation carrier accepts the goods from the seller to ship them to the buyer. In contrast, if the purchase terms are FOB destination, free on board at the destination of the buyer, they remain in the ownership of the seller until they arrive at the buyer's designated point. These are goods in transit that would not be carried by the buyer, but would be carried on the seller inventory until it reaches the buyer's location. Again, transfer of title is the key as to which set of books carries the inventory at month end. As to which party has ownership of the goods, seller or buyer, again based on these two different terms of sale, would determine if there's a catastrophe in shipment of goods as to who would go after the carrier in terms of recovery of costs if the goods were destroyed in transit. So if it be shipping point, if the carrier had an accident, the buyer would go after him because it was in the buyer's title at that time from the seller. Here's a review question for goods in transit. Goods in transit should be included in the inventory of the buyer when D, the terms of sale are FOB shipping point. That's the point that title transfers to the buyer and should be included in the buyer's inventory whether it's arrived or not. Here's a special subject, consigned goods. These are goods held for sale by one party but remain in the ownership of the party that sent it to the seller. This is a way of encouraging sales before the seller is obligated to pay for them. And this is an example that's indicated that the inventory is in the physical hands of the seller, but not on their books until sold. When they're sold, there's a series of quick entries made that indicates that the inventory was in their title when they sold it, but comes off right away upon the sale. These are the four methods that we'll be discussing in this chapter. The specific identification method is one that we'll not be spending time on. As indicated, this is a very detailed record keeping. It's only indicated in cases where inventory is of high value. It's the last three methods, the first in, first out method called FIFO, the last in, first out method called LIFO, and the average cost method that we'll be concentrating on in this chapter. These last three methods are called cost flow assumptions because the flow of costs will follow an assumption that we made and not the physical flow of goods when a sale is made. I'd like to begin with a short illustration of a method that we will not be focusing on in this chapter. That is the specific identification method. This does not require an assumption, but this requires knowledge of the cost of an item sold. So here's the illustration. Crivets TV Company purchased 3 identical TV sets in inventory on February 3rd, the 5th, and May 22nd, all at different costs. And then on June 1, it sold 2 TVs for the sales price indicated. We're just going to deal here with costs and not revenues. So in this case here, we learn that Crivets sold the TVs purchased on February 3rd and May 2nd. That is the cost of $700 for February 3rd and $800 cost on May 22nd. So with that knowledge, that is specific identification, the cost of goods sold is determined to be $1,500. Ending inventory is the remaining unit that was purchased but unsold on March 5th at $750. And so therefore, in this example, our total pool of available costs were all the 3 TVs that were purchased for $700, $750, and $800, or a total of $2,250. And at period end, or after the sale, in this case, those costs were divided into cost of goods sold, $1,500, remaining ending inventory, $750, for a total of $2,250. I just want to illustrate that no matter what method's chosen, whether it's a specific identification method or an assumption that's required, the combination of cost of goods sold for a period of time and ending inventory will always come back to the total pool of available dollars at the time of sale. Now again, the specific identification method is one that's relatively rare in practice. Most companies will make an assumption, a cost flow assumption about which units were sold. And in terms of this, it's an assumption on the flow of cost, not the flow of goods. Because once we're in the sphere of making an assumption, we don't know what the specific costs were on those items sold. The other methods of FIFO, LIFO, and average cost are the ones we'll be concentrating on in this chapter. You can see by this illustration that the FIFO method is by far the most popular, followed by LIFO, and then average cost. Once we rely upon one of these assumptions to determine our cost of goods sold, and then by default our ending inventory values, it's important to note that this does not need to match, and likely will not match, the physical movement of goods. We need not determine our cost of goods sold by knowing the physical movement of goods and their associated individual unit costs. We can make assumptions. This is accepted by generally accepted accounting principles. Okay, now we're moving to an illustration that uses the cost flow assumptions, not the specific identification method. Here our data for Houston Electronics indicates that we've got total units available for sale of 1,000 units costing $12,000, comprised of a beginning inventory and 3 purchases. The assumption here is that we are selling 550 units, and so therefore there'll be 450 units left in any inventory. The key solution is, what's the value of those 550 units sold? In other words, what will go into the income statement as a cost of goods sold, and what remains behind on the balance sheet in ending inventory. It'll be some combination of the $12,000 total pool cost, if you will, of items available for sale during this period of time, from beginning January to end November. We'll look at the first in, first out method first, the FIFO method. All of these acronyms, such as FIFO, LIFO, refer to the assumed order in which the cost of goods sold is first calculated. So in first in, first out, the earliest goods purchased are assumed to be the first sold, first out the door. As indicated, this often does parallel the actual physical flow of merchandise, but it need not. All of these methods are assumptions of cost flows and are not attempting to track the actual physical flow and therefore the cost of merchandise in that actual physical flow. The premise is we do not know the specific cost of goods sold for items sold. We make an assumption. Okay, for FIFO, we have a word of caution. This first demonstration of FIFO, LIFO, and average cost are done using the periodic method of inventory. Only when we get to the end of these slides in the appendix will we do the perpetual. But in terms of teachability, your textbook likes to show you the periodic method because it's easier to see the cost flow assumptions. When we move to the periodic method, you require more detailed calculations on a sequential basis. Periodic, you start with a view for the whole period, and then knowing and given that total view, which we're looking at right here, you simply pick the sequence that goes into cost of goods sold and the sequence that stays in ending inventory. The author here likes to value the ending inventory first and the cost of goods second. Not a big deal. We'll go with the flow here. So, from the previous slide, we noted that there were 550 units assumed to be sold in this example. For FIFO, we want to go to the top layers to get our cost of goods sold, and the bottom layers, the more recent layers that stay in inventory. So let's do our ending inventory first. If we have 550 units sold, we have a total of 1,000 units in total. That means we have 450 units in remaining ending inventory, comprising the most recent layers. The November 27th layer of $413 will remain in ending inventory. And then only 50 of the August 24th purchase of 300 at $12 each will remain in ending inventory, for a total value of $1,500 assigned to those 450 units in ending inventory. Cost of goods sold, we start from the opposite side, or the top of it. The earliest layers are assumed to be sold first. To determine cost of goods sold, we could go through individual layers, the earliest layers, and derive the cost of the 550 units sold. But here's the reason the author used this method. Once you determine ending inventory, you can back into cost of goods sold. Why? Because between ending inventory and cost of goods sold, it must equal the $12,000 total pool available cost during the period of time. So if our ending inventory is $1,500 and our total pool is $12,000, the difference, or $6,200, is our cost assigned to cost of goods sold in the income statement. So in this example, the $6,200 is in the income statement as an expense, and the ending inventory of $5,800 is an asset in the balance sheet, a current asset. Just an illustration of this FIFO method. This graphic clearly illustrates that in terms of cost of goods sold, it's the earlier layers, those valued at $1,000, $2,200, and $3,000, that comprise cost of goods sold, or $6,200 per the previous calculation. And then the most recent layers purchased remain in inventory, totaling $1,500 on the previous page. Moving to the last in, first out method, the latest goods purchased are assumed to be the first sold. Again, this seldom coincides with actual physical flow of merchandise, but that is irrelevant. We're making an assumption here and just being consistent. Under the LIFO method, we assume that the most recent purchases, November 27th, August 24th, these comprise the units sold, and the earlier purchases remain in inventory. So looking at ending inventory, again, 450 units. We'll start with the top layer, 100 units at $10. These stay in inventory. Second layer, 200 at $11 each. Another layer of ending inventory. And of the August 24th purchase, of those 300, only 150 remain in ending inventory. That totals the 450 that's assumed not to be sold, valued as indicated by those individual unit costs. To determine cost of goods sold, we simply take our total available pool, $12,000, subtract out our ending inventory of $5,000, and calculate our cost of goods sold of $7,000. That check, ending inventory value, cost of goods sold, always must come back to the pool of total available dollars. We'll see this whether in the periodic method or the perpetual method later. Again, a graphic showing the LIFO, that the layers purchased last, 5,200, 1,800, are assumed to be sold first, and therefore the earlier layers stay in inventory, comprising of $5,000 of total ending inventory versus $7,000 of cost of goods sold expense in the income statement. Remember, again, those both total $12,000 as a check. Total available pool must equal the allocation between ending inventory costs and cost of goods sold. Moving to average cost. Here we calculate an average cost for the period, and that's the basis of valuing our cost of goods sold and also our ending inventory. All we need to do here is to calculate an average cost for the period, January through November, total of $12,000 and 1,000 units, so the average cost for the entire period is $12 per unit. How do we value ending inventory? Total units of 450 times $12, or $5,400. Cost of goods sold, again, the difference between our available pool of $12,000 less ending inventory of $5,400, giving a cost of goods sold of $6,600. Remember, we could calculate that very quickly by using the same average cost of $12 per unit times our total 550 units sold, assumed several slides back. So 550 sold at $12 equals that $6,600 shown as cost of goods sold. Again, a graphic here under the periodic method. The total $12 per unit feeds into ending inventory and cost of goods sold at the same average cost for the period. These calculations will be more involved using the periodic method later. using the perpetual method later. This is the periodic shown here. Perpetual will make calculations on a daily basis to come up with different averages during the period of time. Why? Because we're constantly updating inventory under the perpetual method, and therefore there's more calculations. This slide demonstrates the effect of a choice of the FIFO, LIFO, or average cost method to calculate cost of goods sold, and likewise the resultant ending inventory values. These are three examples with the same assumed units sold and ending inventory. That is, we sold 550 units in every example here, but look at the cost of goods sold is valued differently under FIFO, LIFO, and average cost. Likewise, the ending inventory is valued differently under FIFO, LIFO, and average cost. So just based on our assumption of cost flow methods, we can get different results in our income statement and different results in our balance sheet, the balance sheet being the ending inventory. What I'd like to point out here is that under an assumption of an inflationary economy, that is, our purchase costs are increasing over time, if the LIFO method is adopted, the more recent costs, the higher costs, are matched to the income statement when goods are sold, and therefore the net income or bottom line profit is lower at $17.50. Under FIFO, it just reverses the order. It's assumed that the earlier costs, the first costs, are the first ones out the door, the earlier costs being lower priced, and so therefore the cost of goods sold is lower, $6,200 compared to the LIFO at $7,000, and therefore a lower cost of goods sold, a higher net income of $23.10 under FIFO. The average cost method is right in between. The cost of goods sold is right in between $6,200 and $7,000 at $6,600, and likewise ending inventory is right in the middle of the ending inventory under the FIFO or LIFO method. Again, any one of these three methods are acceptable under U.S. generally accepted accounting principles. Once adopted, consistency is simply required from period to period. Review question. The cost flow method that often parallels the actual physical flow of merchandise is the FIFO method. But again, once we make an assumption, a cost flow assumption, we are not seeking to track the cost of goods sold that are attached to the physical flow because we don't know which ones were sold. Only the specific identification method has that knowledge. Question. In a period of inflation, the cost flow method that results in the lowest income taxes is the LIFO method. Why? Because the LIFO method produces a higher cost of goods sold and therefore lower profit. Taxes are based on profit and therefore lower profit, lower taxes. This is a primary motivation of U.S. companies to use the LIFO method. It results in lower taxes in the short run. As indicated, once a cost flow method for inventory costing is adopted, consistency should be maintained. And furthermore, a company needs to footnote this as to what method they're using. Because companies with the same results of operations in terms of sales and cost of goods purchased can have different net income numbers, different ending inventory numbers based on the selected cost flow assumption they choose, LIFO, FIFO, or weighted average. This topic of inventory costing, lower of cost or market, is covered in the chapter. I'm not going to focus on it, but I will mention its purpose. It's possible that a company's inventory may decline in value, meaning that its replacement cost may be lower than its actual purchase cost. Why? There could be some items that have a short useful life due to technology, or they may become damaged. In any event, if the replacement cost is lower than the purchase cost, companies are required to write down the inventory to its market value in the period in which the price decline occurs. So market value in this sense here is replacement cost that's lower than the original purchase cost. If that circumstance exists, companies must write it down under the theory that the inventory value should not be higher than what a cost can recover, in effect in a fire sale, selling it for lower than its original cost. So it takes the hit in its income statement during the period of time in which the market value or replacement cost, market value being defined as replacement cost, declines lower than original purchase cost. This is simply an illustration of that principle. We see that for this Kentucky TV company, it purchased flat screen TVs and radios at the cost column indicated there. And at the end of a period of time, the replacement cost for those same inventory items are shown in the market column here. So flat screen TVs, a total value of $60,000 original cost, only has a market value, a current market value of $55,000. So under the lower cost or market, the company needs to write that down. When it writes it down, it removes the cost from inventory and charges an expense, a write-down expense. And so the lower cost of market valuation here would be the lower $55,000, lower than original cost. Satellite radios, the market value, the replacement cost has risen during the period of time. It can't write it up, so it simply maintains that original cost of $45,000. DVD recorders, original cost $48,000 ending inventory. Its market value has declined for various reasons to $45,000, and therefore the write-down will be at $45,000 carried as ending inventory, and not the original $48,000. DVDs, they went down $1,000, current market replacement cost versus original cost, and therefore it'll be carried at $14,000. So the total inventory value would be carried at $159,000 at the end of the period under the lower of cost or market principle. This would be compared with the original cost of all these items, which, if we add up the cost column, it totals $168,000, but we carry the inventory value at $159,000. As mentioned, the write-off would reduce the inventory, it would credit inventory, and debit a write-down expense in the income statement. This illustration shows the interplay between ending inventory and cost of goods sold. The beginning inventory plus any cost of goods purchased form this pool of total available dollars during any period of time. And at the end of that period of time, either the items are still in inventory, valued at ending inventory costs at whatever assumption, or it's sold and therefore in the cost of goods sold in the income statement. So if there's an error for whatever reason in ending inventory, we can see the impact on both the income statement and the balance sheet. For instance, if an inventory error occurs where the beginning inventory is understated, if the beginning inventory is understated, the pool of dollars is understated, and therefore the cost of goods sold for the current period is understated, and net income is therefore overstated. If the beginning inventory itself is overstated, the pool is overstated, and if ending inventory is correct, cost of goods sold is overstated, again because that pool had more dollars in it than it should have. The more common illustration here is if the ending inventory is in error. If the ending inventory is understated in value, that would overstate the cost of goods sold and therefore understate net income. Likewise, if ending inventory is overstated, the cost of goods sold is understated and net income is overstated. Again, ending inventory and cost of goods sold together must equal the pool of dollars formed by the beginning inventory and cost of goods sold and cost of goods purchased during the period of time. This is just a graphic showing the same interaction we just discussed. Beginning balance as an inventory plus all adds or purchases for a period of time form the pool on the left, B plus A. And at the end of the period, either it's still on hand in ending inventory or it's sold and classified as cost of goods sold on the income statement. Just to restate, if ending inventory values, either beginning or ending, are misstated, it's going to impact the cost of goods sold on the income statement. As indicated, inventory errors affect the computation of cost of goods sold not only in the current period but also in the successive period. So, if ending inventory is wrong, that ending inventory is the beginning inventory of the next period. And so therefore the errors will offset each other, but both periods will have misstated results if the inventory values are wrong in any particular period. Here's an example of that principle of errors affecting two periods of time. For 2011, if we assume that our ending inventory of $12,000 is incorrect, that is understated, it should have been $15,000. If our ending inventory is understated, that means our cost of goods sold will be overstated at $48,000 compared to what it should have been at $45,000 had the ending inventory been $15,000. So with an incorrect ending inventory, that means a higher cost of goods sold and therefore a lower net income. $22,000 in this case compared to $25,000 is what it should have been had the ending inventory been correct. Again, this is an error for whatever purpose. Now likewise, moving to 2012, following through that incorrect inventory, ending inventory of $12,000 becomes the beginning inventory of the next period of time. So that pool of dollars in 2012 is lower than it otherwise would have been because of the error, $80,000, versus it would have been at $83,000 had the inventory been correct from the get-go, with a lower total available costs. If the ending inventory in 2012 is correct at $23,000 in both cases here, we see though that the cost of goods sold in 2012 is at $57,000, lower than it otherwise would have been. And so therefore, with a lower cost of goods sold because of a lower beginning value that formed a lower total cost of goods available, we see that there's a increase in net income in the second period offsetting the decrease due to the error in the first period. So we have a $13,000 net income in the second period when it should have been $10,000. So between the 22 and the 13, that's the same total as $25,000 in income and $10,000 in income respectively had the inventory been correct at the end of 2011. The combined income for the two-year period is correct. However, the individual periods are incorrect because of that one error of ending inventory being incorrect at the end of 2011. Review question. Understating inventory will overstate cost of goods sold. Because again, the total value between the ending inventory valuation and cost of goods sold will equal the total available dollars for that period of time. So if one of the ending components is wrong, the other component will be wrong in opposite direction. As a reminder at the bottom, at period end, items are either still in ending inventory or they're sold. So misstating ending inventory results in a misstatement of the cost of goods sold in an opposite direction. This slide is a reminder that for presentation purposes and financial statements, inventory is classified as a current asset, meaning that it's expected to turn into cash within the operating cycle or 12 months, whichever is less of the business. The cost of goods sold is the major expense item on the income statement, subtracted from sales to arrive at net sales. Financial statements should also disclose the major inventory classifications, meaning if it's a manufacturer, they should show the detail of raw materials versus work in process inventory versus finished goods. If it's just a retailer, there'd be one classification of inventory, items held for resale, and it could simply be called inventory in that regard. For retailer, it is only items for resale and not The stage of completion does not change as in a manufacturer. The basis of accounting must be indicated that the inventories are stated at cost or lower cost or market, and the assumed costing method must be stated in footnotes. FIFO, LIFO, or average cost if specific identification method is not used. Again, that last method is rarely used in companies because it's very cost prohibitive to implement. What is it meant in this slide that inventory management is a double-edged sword? Well, companies don't want to lose sales, so therefore they'll stock inventory levels so as not to cut off sales at the beginning of a period. However, there are costs associated with high inventory levels. First of all, you must purchase them. They must be stored. They may be subject to damage or obsolescence if there's a high level of inventory. Likewise, if the company does not carry very high inventory levels, it may lead to stockouts, meaning lost sales. And so the appropriate level of inventory is one that must be determined by each company based on their experience of not losing sales, but not carrying more inventory than they need to service their current sales of the coming period. There's two ratios covered in this chapter. One is an inventory turnover ratio. The other is days in inventory. What do these mean? As indicated, inventory turnover measures the number of times an average inventory is sold during the period. So we calculate this at the end of a period of time, let's say a year, where we know the total cost of goods sold for the year, and we take our average inventory for that period of time, beginning inventory plus ending divided by 2 gives us an average, and this inventory turnover ratio tells us how frequently, how many times a year is inventory turned over, is it sold. Higher inventory turnover is better than lower inventory turnover. If a company has a very low inventory turnover ratio, that means they may have items that are being held. If companies have a low inventory turnover ratio, that means the risk of inventory perhaps becoming obsolete is higher than otherwise. The days in inventory ratio simply takes the inventory turnover as measured in the first ratio and divides it into the total number of days in a year to get the average days in inventory that's represented by a given inventory level. This measures the average number of days that inventory is held. In this case here, a high days in inventory would be a riskier strategy than a lower days in inventory. Let's look how this is played out in an example. For the year 2010, Walmart reported a total cost of goods sold for the year of $304 million. The beginning inventory, merchandise inventory on its balance sheet was $34,511,000, ending inventory $33,160. We add those two together and divide by 2 to get an average inventory. Let's illustrate the computation of inventory turnover. For Walmart, for the year 2010, it reported a total cost of goods sold of $304,657,000 for the year. Beginning inventory was $34,511,000. Ending inventory of merchandise on its balance sheet was $33,160. Let's add those two together, divide by 2, so our average inventory for the year is calculated at $33,835,000. Divide that into $304,657,000, and our inventory turnover ratio is 9 times. That means during the year, our average inventory was sold 9 times. Again, the higher this turnover ratio, the better. Inventory is fresher, less subject to obsolescence. Let's calculate days in inventory. Once we have inventory turnover, we simply take 365 days in a year, divided by 9, come up with 40.6 days in inventory. This is the approximate time it takes to sell that inventory for this company, 40.6 days. The lower the days in inventory number, the better, meaning that the, again, risk of obsolescence is lower if you're turning inventory. If you're days in inventory, your time held is lower rather than higher. Now I want to look at the coverage in the appendix of this chapter using the perpetual inventory system. This is the key inventory system I want to discuss in this chapter, not the periodic that we saw earlier. The perpetual inventory system will have a few more detailed calculations, but uses the same principles in terms of the cost flow assumptions that we saw earlier. Now we're assuming the same data, that is, beginning inventory plus all purchases for the time period equal $12,000 total pool cost for goods available from January through November. The ending inventory of 450 units is the same assumption that we had earlier. And if I add the available units, beginning inventory of 100, purchases of 200 in April, another 300 in August, and another 400 in November, we have a total of 1,000 available during the period. We sold the 550 on September 10th. That computes to the 450 remaining at the end of November. Let's look at how we determine cost of goods sold and ending inventory under first in, first out using the perpetual inventory system. First of all, let's lay in our beginning inventory, 100 units at $10 each, $1,000. The next step here, April 15th, we bought 200 more at $11 each. Now, when it comes to the perpetual inventory system, it's critical that we evaluate all our activity, be it a purchase or a sale, in exact date sequence order. To get out of sequence would be to generate an incorrect result. So on April 15th, we bought 200 units at a higher unit cost of $11. Nothing was sold on that day. And so therefore, the ending inventory is a combination of the first layer, 100 units at $10. Those are unsold. We simply bring those down, plus the new layer of 200 units at $11 each. Extend those out, and our total inventory value is $3,200. The key to doing perpetual inventory for FIFO and LIFO is keeping our ending units in inventory in layers if there's different unit cost applicable to that which is in inventory. The next sequence, August 24th, we purchased 300 more units at $12. Again, in an inflationary economy, our unit costs are going up. Nothing was sold on that day. And so therefore, our ending balance, we bring down the first two layers, 100 at 10, 200 at 11, and add the most recent layer, 300 at 12. Those individually extended total $6,800 ending inventory value at the end of August 24th. Now, September 10th, we sold. Now, September 10th, rather, we sold 550 units. Under first in, first out cost flow assumption, we want to calculate our cost of goods sold. So our earlier layers, our first layers, are assumed to be the first out the door upon a sale. So we'll first assume that we sell the layer of 100 at $10. Secondly, the second layer, 200 at $11. The third layer, we only need to sell 250 because the 250 plus 200 and 100 equals a total of 550 we sold. So we just need 250 of the $12 unit. And so our total cost of goods sold, extending those out individually, are $6,200. Now, what's the ending inventory? We've taken care of the first layer completely. The second layer is assumed sold. And only the third layer, 300, that we took 250 out, we have a remainder of 50 at $12 or a $600 ending balance as of September 10th. Next date in sequence, November 22nd, we bought 400 additional units at $13 each. Again, inflationary assumption is made here. Nothing was sold on that day, So therefore, we'll bring our layer of $50 at $12 down, untouched, and add our $400 at $13. Extend those out individually, and our total ending inventory at the end of November is $5,800. Now I'd like to quickly prove out the accuracy of our cost of goods sold at $6,200 and the resultant $5,800 ending inventory. If we add those two numbers together, cost of goods sold plus ending inventory, $6,200 plus $1,500, that totals $12,000. That is the total available pool of dollars during the period of time, January through November. Where does that total pool come from? Beginning inventory of $1,000, April 15th purchases of $2,200, August 24th purchase of $3,600, and November 27th purchase of $5,200. That's the total pool of $12,000. At period end, we either still have them on hand or they're sold. That's the quick check to ensure that your calculation of cost of goods sold and resultant ending inventory under the given cost assumption is correct. Let's move to a LIFO cost flow assumption. Same example. We'll bring in our beginning inventory of 100 units at $10 each. Total of $1,000 beginning inventory value for the year. Purchase $211 on the 15th. No change here. Bring down that first layer because we didn't sell anything on that day, and add on our purchase cost of 200 units at $11. They total $3,200, no change from the previous FIFO example. Likewise, on the August 24th purchase, there was nothing sold on that day, and so therefore we have three layers. Bring the 100 down at 10, the 100 down, the 200 at 11, and the new layer purchased on this day, 300 units at $12, again totaling $6,800 when individually extended. Now we sell 550 units on September 10th. Watch how our cost of goods sold calculation is going to be different. Under LIFO, we're going to assume that the last layers, the most recent costs, are the first ones out the door when we determine cost of goods sold on the income statement. So looking at our last layer first, 300 units at $12, that's assumed to go out first. Again, this is just an assumption. This is not the physical flow. We do not know the physical flow. Next, we attack the next most recent layer of 200 at $11 each. And all we need is 50 more units at the $10 layer to come up with a total cost of goods sold on September 10th under the LIFO assumption of $6,300. This is a higher cost of goods sold than the FIFO method because we're using more recent levels at costs which are increasing. What's our ending inventory balance at September 10th? Well, we've assumed we've wiped out the last layer and the second layer, so all we have is 50 units of the first layer at $10 or $500. Note that under the LIFO assumption, if the most recent costs are assumed to go out the door in terms of cost of goods sold, the earlier units stay in inventory, and so therefore the ending balance under LIFO assumptions is lower than it was under FIFO. November 27th, we bought 400 units at 13. Nothing was sold on that day, so therefore our ending inventory is we bring down the 50 at $10 untouched and add the last layer purchased at $13 each, extend them individually. Total ending inventory is $5,700. Again, a quick check of the accuracy of our cost of goods sold and resultant ending inventory balance. Add up $5,700 ending inventory plus $6,300 cost of goods sold equals $12,000, which is our total available pool during this time period. Now let's look at the average cost method, also referred to as the weighted average cost method. Again, same data. We'll obtain different cost of goods sold and different ending balances just based on our assumption of flow of costs through the inventory account. We have beginning balance laid in here, 100 units at $10 each. We purchased 200 at $11. Now, in this average cost, we must recalculate changes in average cost every time we have a new purchase at a different unit cost. So first of all, our total value is $2,200 plus $1,000 or $3,200 divided by the total units, 100 beginning plus 200 purchased or 300, to obtain an average cost of $10.66 each. This is a weighted average cost, meaning it's weighted by the goods at the individual levels of unit cost. It's not simply $10 plus 11 is 21 divided by 2 is 10.50. It's not 10.50. It's $10.667 because we purchased more at the higher $11 than there were at the original layer of $10, only 100 at that level. Nothing was sold on that day. August 24th, we have a new purchase, 300 units at $12. Our weighted average cost is going to change here. It's going to increase. First of all, let's calculate our total dollars in inventory. $3,200 comes down from the previous ending inventory, plus our purchase of $3,600. That's $6,800. That number must be calculated first, and then we divide by the total units in inventory, 300 previously plus 300 purchased, 600, to arrive at our new weighted average cost of $11.333. Again, the weighted average cost on the perpetual method here is calculated last in terms of the ending inventory value. We do not need individual layers here because it's average cost, not maintaining the distinction of our $10, $11, and $12 layers under LIFO and FIFO. Now, September 10th, we sold 550 units. What's the cost of goods sold? It comes from our weighted average in inventory, 550 at $11.333, or our cost of goods sold is $6,233. What's our ending inventory? 600 less 550, or 50 units at the same $11.333 or $567. November 27th, we purchased more units at an increased cost of $13. Nothing was sold that day, so therefore we have to recalculate a new weighted average in ending inventory. First of all, I'm going to calculate the total dollar value. The $567 comes down from the previous day's ending inventory, September 10th, plus $5,200, $57.67. I'm going to take that, divide it by the total of 450 units to come up with my resultant new weighted average, $12.816. Again, the quick check on the accuracy of our cost of goods sold calculation and our ending inventory, because we know that that interaction must tie back to our total available dollars, total pool of dollars. So cost of goods sold, 6233 plus ending inventory, 5767 equals $12,000. It checks out. Here's a final topic in the appendix of Chapter 6, which I'd like you to be familiar with, the gross profit method. Why is this used and what is it? First of all, it's possible that businesses may have a casualty loss, such as a fire, and if they did not have the perpetual method of inventory, knowing what their ending inventory was at the end of any particular day, they would have to estimate it. The gross profit method allows an estimation of the ending inventory by use of the formula shown here. First of all, to estimate ending inventories when it's not known, for instance, it was destroyed by fire, we have to know our net sales for the period of time. Secondly, we have to use an historical gross profit percentage. Companies generally have a gross profit margin, which is gross profit dollars divided by net sales. That percentage is generally pretty steady. They try to increase it over time, but it does not jump around. And so therefore, previous periods' gross profit percentages can be used to estimate ending inventory. How to do that? If we use our historical gross profit percent based on our known net sales, we can then back into our cost of goods sold, because of the formula right here. Gross profit is a function of net sales less cost of goods sold equaling gross profit. So estimating gross profit, we can back into cost of goods sold. Once we have an estimate of cost of goods sold, we can put it in this formula right here. Step 1. With estimated gross profit and known net sales, as indicated, we have an estimated cost of goods sold. Looking at our total available pool of dollars for the period, and this must be known by other records, total beginning inventory plus purchases during the period of time, we can subtract out our estimated cost of goods sold from the calculation above and come up with an estimated cost of ending inventory. Why? Because we know the interaction between ending inventory and cost of goods sold must come back to that total available pool of dollars. Again, the premise here is that we know our net sales, we know our total pool of available dollars, we just don't know our ending inventory, and so we're backing into it by means of this estimation process. This T-account graphic simply illustrates that principle. If we know our total goods available for sale during the period of time, that is beginning inventory plus any purchases during the period of time, and we can estimate our cost of goods sold items by use of the gross profit method, historical gross profit based on known net sales, we can back into our ending inventory and estimate that if it's not known or if it's been destroyed by some casualty loss such as fire. So the relationship is B plus A, beginning inventory plus additions or purchases, equals ending inventory and cost of goods sold. BA equals SE. In this case here, the whole purpose of the gross profit method is to estimate our ending inventory by first estimating our cost of goods sold and knowing our total pool of dollars, B plus A. Let's illustrate this gross profit method with an example. The Kawasaki Company records for the month show that they had net sales of $200,000, known beginning inventory of $40,000, and a cost of goods purchased of $120,000. Again, these are all known. What the company does not know is it's our ending inventory. Historically, the company expects to earn a 30% gross profit rate. What does that mean? That means based on its net sales, 30% of that, they should earn a gross profit of $60,000. If they estimate that, they can back into their cost of goods sold by difference, because net sales less cost of goods sold equals gross profit. So we're estimating gross profit here of $60,000 and backing into an estimated cost of goods sold for the period. With that estimate of cost of goods sold, we subtract that from the total goods available for sale of $160,000. That pool of $160,000 must be known by other records. So we back out the estimated cost of goods sold of $140 to come down to an estimated cost of inventory of $20,000. Again, this gross profit method is used to estimate ending inventory if it's not known, let's say destroyed by a fire. Why would companies do this? If the inventory was destroyed by fire and they didn't have perpetual inventory records, on what basis would they submit a claim to their insurance company? This is the calculation of a possible claim sent to the insurance company by using historical information. Again, just a graphic of that illustration. We must know the total goods available for sale, the 40 plus 120, or total of $160,000. We must be in a position to estimate our cost of goods sold of $140. And if we can estimate that, we can estimate our ending inventory of $20,000, because the ending inventory plus the estimate of cost of goods sold must equal the total cost of goods available for sale of $160,000. Just some endpoints here for the chapter. The definitions for inventory are essentially the same under generally accepted accounting principles in the U.S. versus the International Financial Reporting Standards, an organization in London. Both define inventory as either goods to be consumed in the production process for a manufacturer, that is raw materials, or items in the process of production for sale, work in process, or items that are completely finished goods. These three classifications for a manufacturer are the same under International GAAP as they are under US GAAP. In terms of when title transfers, who owns the goods, it's the same under international standards as US GAAP. Both US GAAP and International Financial Reporting Standards permit the specific identification method when appropriate. Interesting here that the International Standards actually requires the use of this when inventory items are not interchangeable, that is, when they can be distinguished. US GAAP does not specify in which cases specific identification must be used. It is not a very common practice in the US. What is used is one of the cost flow assumptions, LIFO, FIFO, or weighted average, in terms of inventory costing purposes. A major difference indicated here between International Financial Reporting Standards and US GAAP relates to the LIFO cost flow assumption. US GAAP permits the use of this. International Financial Standards prohibits its use. LIFO is not allowed for use in international accounting standards. Self-test question. Which method of inventory costing is prohibited under International Financial Reporting Standards? C. LIFO is prohibited. That's only allowed in the US. And primarily because of the tax advantage it provides in the short term under an inflationary economy. Higher cost of goods sold, lower net income, therefore lower corporate taxes using LIFO. That's a temporary phenomenon. It reverses itself over time as inventory is completely sold. Under inflationary times, use of LIFO would result in what? A. Results in lower income taxes because cost of goods sold is higher, because it uses more recent costs, and therefore profits are lower, and taxes are based on profits before taxes are calculated.